Okay, so now let's talk about how to pay for the car that you want to buy. So the obvious answer, or one obvious pathway to do this, is just to buy it with the cash that you have on hand. And so you may choose to do this if you just don't want to deal with the loan, if you have enough cash kind of saved up and you just want to buy the cash and not have the hassle of having to get a auto loan. But oftentimes this is not the case for most people, and they don't have quite enough savings, especially for a new car, to just buy the car outright. So let's talk about what it takes to get an auto loan. So the first question is, where can you get an auto loan from? So there are a couple of different options. There's banks and credit unions. So you can basically get a loan for buying a car from the bank that you bank with, or other banks or credit unions. They are all in the business of offering auto loans. And so it's worth checking the rates for auto loans from these institutions before you go to the dealer or wherever you're going to buy the car from, because the other option is basically getting a loan directly from the dealer or the manufacturer. So when you go to, for example, a Honda dealership, they will not only offer to sell you a vehicle, they'll also offer to provide you financing for the vehicle. So basically giving you an auto loan. So you can either choose to get financing from the dealer, or if you have an auto loan kind of set up with your bank or credit union before you get to the dealer, you can also basically finance the purchase using that loan. So what do you need to apply for a loan? So you're first going to need to provide a social security or an ITIN number, because that's how the lender, either the bank or the dealer, is going to look up your credit score. You're going to need some income and income sources that the lender will verify, employment information, which is related to your income, your credit score, and information on your other debts, which is kind of incorporated in your credit score. And so that might just be part of the credit report that the lender is going to pull up. So, what are the typical terms of an auto loan? So, they're usually 4 to 6 years, and the longer the term, the lower the payment, but the more interest you will pay over the life of the loan. So you may compare the payment for a 4 year loan versus a 6 year loan. And the 6 year loan will have a lower monthly payment, but if you calculated the amount of interest that you're going to be paying, you're going to end up be paying much more over 6 years as compared to the 4 years. So it's like, are you willing to kind of take the pain up front with the 4 year loan and pay off the loan faster so that you don't end up spending as much on interest? Because it's a little seductive with the lower monthly payment for the 6 year loan or the longer term loan. But if you can afford it, you should try to basically get a shorter term loan and pay it off, because in the end you'll end up saving on interest expense. So rates, the rates are pretty low, oftentimes lower than mortgage rates, and some dealers even offer zero or very low interest financing for highly qualified borrowers. And who are the highly qualified borrowers? It's typically people with really good credit scores. So this is just another reason to really take care of your credit and your credit score, because you can have access to these kind of special financing offers when you're buying a car. So down payments are often required, especially for new cars. So you will have to come out of pocket at least some amount, most likely, even if you're going to get a loan. So if the car, for example, was $30,000, you may have to come out of pocket $5,000 and then finance the rest of the 25,000 to make the purchase. So you can't just go in with zero savings or no money to put down when you're going to buy a car, even if you're going to finance it. So obviously it's going to be less than if you just bought the car cash, but you will be required to put something down, most likely. Basically, the payment schedule is fully amortizing, meaning that you just make a set monthly payment, and at the end of the term the loan is paid off. So fully amortizing means that the payment includes enough principal each month that the loan is fully paid off by the time that it matures. So you have a set payment every month, and it's done at the end of the loan. Some other types of loans, not all loans, will have for example, an interest only period where you're just paying interest and there's no pay down of the principal. And so at the end of the loan, on the maturity date, there will be some lump sum amount you'd have to pay off. But for auto loans, they don't do this, and basically, as long as you keep making your monthly payment that you know upfront, the loan will be paid off by the end. And just a word of caution here, a lot of times you may find yourself being offered a really attractive interest rate, but there are various fees that they often will tack onto these auto loans. And so it's worth looking at the fees and kind of taking them into account to figure out your total cost of the loan, to take these fees into account when comparing different lenders too, because some may offer you a headline interest rate that's lower, but they'll have a bunch of fees that will just offset the lower interest rate. So when you're comparing different options, it's good to also get a sense of what all the fees are so that you can take those into account. So let's talk a little bit more about this decision to pay with cash or auto loan in the situation where you do have enough cash to do so. And especially if you're buying a used car, where you could finance it with a auto loan, but you could also afford to buy it with cash. And so let's just talk about the different trade-offs. So buying with cash has certain advantages. It will, for one, help you not overspend on a car. So if you have a set budget and you don't want to exceed that budget by buying a car, and you limit yourself to how much cash you have saved up, you have kind of a hard limit on what you can buy. So it's one way of sticking within a budget. So another advantage with buying with cash is that you won't pay interest, but you will lose out on potentially investment returns that you could have used that cash for. So for example, if you, let's say you have $5,000 to buy a used car with, option one is you spend the $5,000 to buy the car. So the car, $5,000. And so you'll have interest expense of zero because you bought the car all cash. And but you get your investment return is also zero because you basically bought the car with the money. So the second option is you can basically take out a loan. So for the car, so this is cash. You get a loan. And I'm just gonna, this is not realistic because no one's gonna give you a loan for the entire amount, but let's just, to make the numbers easier. So this is a $5,000 loan that you get. And so let's say the loan is 1% a year of interest. Okay, so your interest expense is going to be $550 per year. But your return, right? So let's say, so you took out this $5,000 loan. So you still have this $5,000 cash that you had saved up. So let's say you put that into a dividend paying stock where you're earning 4% a year. Okay, so your interest expense is 50, but you're gonna earn on your $5,000, you're gonna be earning 4%. So you're gonna be earning $200. Okay, so the net effect of this is that you're earning $150 per year, right? Because you spent $50 on interest, so this is a negative, but you're gaining 200. So the net effect is 150. So in math, it's simple. It's kind of a no-brainer, but logistics wise or operationally wise or just real life, um, for one, this is not guaranteed with all investments, depending on what you're doing with it. You could not even earn this, and you can even lose your $5,000. So there's some risk that's associated with this. And also, the loan is a liability. So um, if you lose your job or whatever happens, you could lose your ability to pay the car payment. So you'll still owe this $5,000 no matter what happens. And so there's a risk that if circumstances change in your life and you're not able to make the payment, then you're going to get your car taken away. So um, this is, but if you had gone with option one, yes, you would not have earned any return, but you would still have your car. Even if you lost your job or whatever, you still own your car because you bought it cash. And so it's kind of you have to weigh your risks. Option one is clearly a lower risk option, but option two, you can earn more money by investing, but you're taking more risk both from your investment and from just taking on this liability of an auto loan. So, hopefully this kind of illustrates the trade-offs. Okay, so what else? You may be able to get a lower price on the vehicle by paying with cash. So there may be, especially for used cars, an opportunity where if you can buy with cash and act quickly, you can get a better deal. There might be certain dealers that would give you a lower price if you paid all cash. So it could potentially open up more opportunities if you paid with cash for getting a lower price on the car. But on the other hand, there may be special financing offers which you can take advantage of by getting an auto loan, such as 0% or low interest. So then, if you could get access to that special financing, then it makes the trade off or the opportunity cost even higher by buying with cash because again you can invest that cash and the spread between the interest and what you're earning on your investment could be even wider if you have kind of these lower interest options. Also, you'll not deplete your savings by paying with cash. So you still have the cash on hand, and so you can potentially earn uh, investment returns on higher return opportunities. So this is kind of the trade-off. Also, you may want to have savings available for emergencies.